One of the ways that I approach investing is I look for things that are obvious. And the reason I do this is because obvious is really hard to see if someone is creating a complicated, complex approach, right? Obvious is weak, obvious is simple, obvious doesn't work. But in reality, obvious is where the power lies. So I want to talk to you about something that's very obvious, and I want to use it from a point of view of the ending of the last recession, which was June of 2009. And let's look at some obvious things here and then take away or attempt to take away the meaning of them. Hey everybody, this is RC Peck, and this is my investment thought, my weekend investment thought. It's so good to have you here. And to me, what is most obvious is that there are only four places to invest your money on the planet. You can put your money in stocks, fixed income, real estate, or commodities. That's it. There is not a fifth or a sixth or a seventh or an eighth. And as soon as you get a paycheck, it goes into fixed income. Cash is a form of fixed income. And it sounds so obvious once you notice this, but if we live and attempt to build complicated approaches and complex approaches, you can't see it. So to me, there's only four horses in this horse race. And from a very obvious point of view, all I want to know is which horse is doing the best. And that's what I want to show you. And I want to look at it from a very specific standpoint. And that standpoint I want to look at it is from the ending of the last recession. So the last recession ended in June of 2009. That recession lasted 18 months, and we are about 98 months into the economic expansion. So let's look at these four horsemen, and I want to look at them in kind of two different shades or through two different lenses. One is just absolute, and the other is through an inflation adjusted. So the first one I'll look at is stocks. So since the end of the recession, stocks, and now guys, I'm calling this stocks, but it's really S&P 500 with dividends reinvested. Stocks are up 208%. But if we look through the filter of inflation, you can see that stocks are only up, in quotes, 172%. So I will come back to those numbers in a minute. But as far as the four horsemen, so far stocks, up 208%, not counting inflation, or 172% counting inflation. Now, a question about inflation or a point about inflation. There is no one inflation. If you live in Silicon Valley, your inflation could be 5 or 6%. If you live in the Midwest, but you have bad health, your inflation could be 7 or 8%. If you're sending your kids to an Ivy League school, your inflation could be 7 or 8%. So your inflation number is very specific based on where you are in your life what your biggest expenses are. The inflation number I'm using is simply the government's CPI, and I won't go into whether they are overstating or understating. I'm just using that number. So the next area is fixed income. It's one of the four horsemen. Fixed income, since the end of the recession in June of 2009, is up 43%. Now, guys, this includes dividends being reinvested. Now, there's lots of different fixed income. The one I'm using is the 10-year U.S. Treasury, and it's up 43%, including dividends. If we adjust this for inflation, it drops to 25% over that time frame. Now, I'm not going to go into whether you should or shouldn't be in fixed income. The point I want to make is, or one of the points I want to make is, one of the safest places your money can be is in a stable uptrend. Now, both fixed income, the 10-year, and stocks are in a stable uptrend, at least from a U.S. point of view. But as you can see, one has moved up 208%, and the other one has moved up 43%. Now, the third horseman, in no particular order necessarily, is real estate. Now, since the end of the recession, real estate, and this is a U.S. Number, it's up 39%. And as you look at the screen, as you look at this price chart, you can see that in hindsight, we saw that real estate did not bottom officially nationwide in the US until the beginning of 2012. Now, if you adjust this for inflation, you can see that real estate is only up 23% inflation adjusted. Now, I want to point this out for people who are calling for a collapse in real estate. Harry Dent saying that real estate's going to collapse 40%. But when you think about these numbers, real estate being up 39% unadjusted for inflation or being up 23% adjusted for inflation, that's not a nosebleed number. Even still, unadjusted for inflation, real estate is still 6% below its 2006 high. If you adjust for inflation, it's 23% below its 2006 high. So people calling for a collapse in real estate, I'm not sure what they're looking at, but the obvious answer is real estate is going higher. It is still below its lifetime high of 2006. And not only is it below that, but interest rates have fallen noticeably in that 11 years. And then the last of the four horsemen is commodities. Now, your brain, when you look at this price chart, this is unadjusted for inflation. You can see that commodities are down, let's just call it a third. It's actually down 32%. Last week, I talked about commodities, how they may be finally bottoming. But if you adjust it for inflation, it's down 38%. Now, again, with commodities and fixed income and real estate and stocks, I'm not breaking down all the different parts, right? So clearly commodities has an energy sector, a agriculture sector, and a metals sector. I'm not digging into each sector. I'm simply pointing that this one major asset class has been hit really hard. And there will be a point where it comes back, and maybe it has already bottomed. Maybe we are already in the first inning of a 9-inning game of commodities coming back. The point I want to make is we have 4 places to invest on the planet. Since the end of the recession, 98 months into this economic expansion, stocks are up 208%. Fixed income is up 43%, or 1/5. Real estate is up 39%, almost the same as fixed income, interesting enough, and commodities are down by a third. Again, that's unadjusted for inflation. The numbers don't look any better if I do adjust them for inflation. So here's the point, and here's really the takeaway of this week's investment thought. I want you to look for things that are obvious. And I get that it's very hard for the brain to look for obvious because we want to create complexity and complication in all areas of our life because then it gives us a job to do. And in many ways, we in the developed world, we in the top 2% of the world, we don't have anything to worry about anymore, really. And that's a problem for the brain. There are not things with big teeth running at us. We have most people, even people in Mississippi, on welfare. They have a house, they have food, they have cable. Please go drive through Mississippi. Notice how poor health the entire state is in. But all of their basic needs are already met. So if you are in the top 2%, and I'm willing to bet most people are who are listening to this, all of your basic needs, remember Maslow's hierarchy, have been met. And so we have to go out and look for other things to survive. That's why it's hard to see the obvious. That's why it's hard to see that there's only 4 places to invest on the planet, only 4. So what's the takeaway? Look for the trends. The trends are where things are the safest. Trends last longer than you can ever imagine, both trending up and trending down. But the world wants to trend. Nature wants to trend. Trend is stability. If you want to write something down today, write that down. You want stable? Look for the trends. Go out in nature. What is the trend in nature? Look at trees. The trend in nature is to just continue growing each year. Incredible stability in nature. And nature is never wrong. So look for things that are obvious. And one is trends, and the other is following the price. Now, those of you who have followed me know that following the price and trends is really the same thing, but I'm just saying it in 2 different ways. Stocks are up 208%. Fixed income is up 43%. Real estate is up 39%. Commodities are up negative 32%. And I know I just said it that way. So look for the trends. The trends are where the stability is where the safety is where the consistency is where the steadiness is. And when you start to notice how to look for them, that's when you start to get the stability and the steadiness and the consistency in your life. And that's ultimately what people want. They want that economic stability. And it doesn't matter what your income is or what your net worth is. If you're still worried about stability, you are not wealthy yet. And the reason I called my company Fearless Wealth is to end that fear cycle so you can find the stability and the safety and the consistency and the steadiness in your life. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, I am so glad you are here, and you do belong here. If you want that investment stability, but you're tired of the hype and the BS. And look, I do want to help you become the smartest investor in the room so you can stop drowning in the drama and the distraction. And the real answer is you are part of the drama and the distraction. People, this is the last holdout. People kind of recognizing who's causing the problem. Stand in front of a mirror and ask that question again, and you'll start to get the insight that helps you become really free. And hey guys, if you valued what you heard today, please like, share, and forward it because it makes a difference. You guys are great, and I will speak to you soon.